My name is Louis, and I work with this company here, 1031 Gateway, and we can talk about that some other time. But tonight I want to talk about ideally two things, but probably just one: the macroeconomic indicators of recession and how real estate investors like us can prepare for it. So mainly tonight I want to convince you that a recession is coming, and then maybe we can brainstorm a little bit as a group, or afterward I have some thoughts on how we can prepare for it. So if that sounds good to you guys. Okay. All right, so first I kind of want to talk maybe just a little bit about market cycles in the real estate market, cycles in the economy, and then talk about where I think we are in the current cycle. And then hopefully maybe with time we can start, as I said, talking about what to do about it. Okay, so as real estate investors, we all already understand that the market cycles. It's cyclical. Whether or not the economy in general is basically on a long-term growth trend, the real estate market goes through somewhat longer term, or sometimes they're called secular cycles. These are crests and troughs in values relative to the trend line. It's not always obvious whether a particular fluctuation in real estate values are attributable to long-lasting economic growth or short-term jiggle, volatility, or if they're part of the cycle. But in hindsight, we can see these cycles emerge. Ideally, the general political, geopolitical, and social conditions would be stable, and we could just enjoy indefinitely long growth and appreciation. But it's just not the case in the real world, the physical universe we occupy. And there's lots of reasons why it cycles. I'll talk about some, we can talk about more, we can get coffee, etc. sometime. Okay, so it cycles. We think it might look kind of like this. So phase one in the lower left quadrant here, we call this recovery. And the reason why we call this initial growth phase recovery is because any economic activity is always already in process. And so we're presuming that this is coming out of a cycle. So we're sort of presupposing our own model here. So we'll call it recovery, or you can call it growth. This initial growth is primarily driven by demand on the consumer side. And there are lots of motivators of demand, but you're all familiar more or less with what this looks like. Occupancy rises, rents can start to be increased, property values start trending up, interest rates are usually still pretty low, and this is usually a pretty good time to buy, but of course you should always perform your due diligence and be realistic about the fact that supply isn't static. Renovations, new constructions are coming wherever there are opportunities that are being conditioned by recovery. So agents like to call this a buyer's market. Okay, phase two is expansion. Things start to accelerate. Oh, sorry. This is where the new construction is. So during the initial stages of growth, we don't have new construction yet. This is our buyer's market, and then supply is gonna lag behind demand a little bit. So there's demand, there's opportunity. So now we're gonna get into new construction. Vacancy is still declining, or I guess I phrase it, occupancy is rising. Okay, supply follows demand. Developers, investors are beginning to recognize opportunities. And so now they're going to start to or accelerate their deployment of capital. New investors are entering the market. Property values are still climbing, and this is like a bull market. This feels really good when values start to rise and peak. You can refinance if you want. So sure, why not? Let's borrow even more money and leverage our good fortune. Maybe we have to borrow at slightly higher interest rates, but that's only because the economy is just doing so well. Maybe we can't find quite as good deals, but we can still make our numbers work out if we compress our margins a little bit, and there's no need to stockpile cash because we're flourishing. Make hay while the sun is shining, etc. But you won't believe what happens next. Hypersupply, and we move into phase three. All the agents are yelping now about it being a seller's market. Investor capital is all tied up in assets. Many of them have become over-leveraged. Labor's becoming expensive. We need to start selling off our flips and short-term holds. So what does that mean for supply and demand when a whole bunch of people who were buyers now become sellers? We just flipped. We decreased our demand and increased our supply We just turned a whole bunch of people from one to the other. And then not only did we turn demanders into suppliers, but now developers are still building. The supply is lagging the demand, and it's going to outrun it. So we've got way too much supply, and now we see people having difficulty selling. But you don't want to lower your prices because you've got all this sunk cost, and you've borrowed at high interest rates, and you're over leveraged, and you're financially log jammed. You don't want to take the losses. So all of the market's greed is now transitioning into fear. Fear is creeping in. At some point, interest rates peak, depending on who's running the Fed, but usually they're going to peak somewhere around here. And what that is the Fed trying to pump the brakes on the economy and trying to hedge against overinflation. But it makes things difficult for us. And lenders are trying to earn money because they're lending at lower interest rates down here. And now that things are flourishing, they're trying to make their money. That makes things even more difficult for investors. 2008, who could get a loan? Who could finance their investment or their home? Okay, so what happens? We ricochet back down, and then we go into recession. People lose jobs, vacancies increase, things are going full cycle, and that looks like the recession that we all just lived through not that long ago. So yeah, if you've paid down debt, if you've saved cash, if you've braced yourself, this can be a good thing if you're sitting on cash, because when prices drop, it becomes a buyer's market again. So I don't have a crystal ball. How do you know when things are going to turn? It's tough. It'd be great if we could track the cycles. We're doing a little bit of that. We can track the prices, but if they're going up, how do you know how much longer they're going to go up for? You've got mouths to feed. You can't just sit on cash and do nothing. And maybe you can, maybe you have enough cash. So you need to make money. You need to ride the wave up. We can all make money on the way up. Kevin McCarthy, House Majority Leader, he tweeted this 1 week ago. The economy is roaring. Communities are safer and our military is stronger. This election is going to be about results versus resistance. Eric Bolling, host of a show about America on Sierra TV, he tweeted on the 2nd, America, we should be saying, Happy Real Donald Trump Day, aka Fully Employed Economy Day, aka Labor Day. Senator Matt Rosendale writes, our economy is booming, all caps, 3 exclamation marks. And here are a few other gems from some senators, representatives, and others on Twitter and in recent news. Sorry to burst everyone's bubble, but I see trains moving all day, every day. If the trains are moving, the economy's booming. Happy Labor Day. Another tweet I saw, pictures of all these now hiring signs. Signs of the times, 3 exclamation marks. All within 2 blocks of the city she lives in. Jobs, jobs, jobs. The economy is growing. Tax Cuts and Jobs Act is working. It's not always necessarily political. Here's an interesting tweet from a few days ago. Senator Sanders, it's clear you got your economic education at your wife's failed institution. The overall economy is booming based on many metrics: GDP, employment, unemployment, manufacturing, jobless claims, etc. And if we add in bonuses, employee wages are improving. Sorry, that was the last political one. Not always political. This is more or less the dominant sentiment right now, the dominant position. The market is euphoric. And the data do bear it out. We do have high GDP, low unemployment, or high employment. I don't know why those are 2 different metrics there, but rising wages according to certain calculations. And we see new construction going on all over the place in downtown. Oh, here's one, a non-political one. This is an analyst, Brian Sawsey. He's the executive editor at The Street. He's been recognized by Starmine as a top-ranked equity research analyst for stocks in more than one category. He just published a piece in which he writes, "Rest easy, a recession is unlikely." So our emotions are really good right now. We feel great. The economy's booming. Not everyone agrees with this assessment. There are some contrarians out there. J.G. Collins from Stuyvesant Square published an editorial in Seeking Alpha in which he laid out data indicating a weakening economy. He lists 5 indicators he thinks points to a strong possibility of recession. On Forbes, Bill Connerly just released a piece analyzing Federal Reserve data. He looked at the yield curve, consumer expectations, unemployment claims, not necessarily unemployment, supplier deliveries, building permits, he found serious warning signs of recession, and there's a few others. Market Watch carried a piece by Ryan Vlastulik that looks at 4 indicators he thinks suggest we're at least pretty late in the cycle. And that's the camp we're in. I think that we're nearing the end of the recovery, and I'll give you 5 reasons why we think so. These are going to be macroeconomic indicators, so broad nationwide statistics or categories of indicators. One of them has a bunch of things in it that all suggest impending recession. We're going to talk about volatility, valuations, confidence, labor, and Fed policy. Volatility is the range of possible prices of a given range of possible prices of a given security or index. So if we have a stable trend line, it's really likely that we're going to continue more or less on the same trajectory for a long time. But if a stock or an index or an asset is volatile, it's less likely to stay on that trajectory. If the line's jiggling, your value could go up or down. So here's the S&P volatility index. Spikes mean volatility. So more volatility means up, down means low volatility. It's just a measure of the jiggle. Okay, so first quarter 2018 maintained significantly higher average volatility than the highest point of volatility in all of 2017. 2018 has already brought us 4 of the 20 largest single-day point drops in the history of the S&P 500. For investors who've been relying on the Fed's suppression of volatility over the past decade, especially over the past 18 months, this might be a bad sign. High volatility precedes recession historically. And here's where we are. We just spiked. All right, tip of volatility. Valuations. We're going to go through a lot of valuations. So it'll take a little bit longer than volatility. This first one, hopefully you find it interesting. So this tracks a metric called enterprise value to EBITDA ratio. So enterprise value, that's kind of like the market cap or the total value of a company. It's a little bit different because you take the market cap, you add in debt, minority interest and preferred shares, and then you take out total cash and cash equivalents. And so this is like the economic value of a company, how much a company is worth. Or the minimum amount that someone who wants to buy a company would have to pay to take over the thing. EBITDA, it's earnings before interest, taxes, depreciation, amortization. So EBITDA is a good indicator of how profitable a company is. We're talking about their actual earnings. We're not dealing with. We're trying to purify that data from interest, taxes, depreciation, amortization. So we're talking about the value and the earnings, the value of a company to the earnings of the company. That ratio is, for the S&P 500, is what we're tracking. Goes up before recession, and we're now right here at the 98th percentile. So you can see recession right here, and then we've been in recovery, and we're up here, way up here, 98th percentile for EV over EBITDA. It's almost higher than the 2000 dot-com bubble. That's dot-coms right there. Okay. Price to sale ratio is another valuation metric. That's the value of each dollar of a company's revenue. It peaks prior to recession. It's really similar profile here. You can see the dot-com bubble. You can see it actually, I think this gold line actually like goes over the, things are pretty bleak here. We're all getting prescriptions for Zoloft here. We're in the 99th percentile S&P 500 price to sale ratio. So this is in excess of the dot-com peak. We're actually higher than the dot-com bubble right now. Do we have cyclically adjusted price to earnings ratio? Where's our peak? Where are we going to turn here? So this is like market value per share over earnings per share. It's exceeded right now, where we are now, is only exceeded by the peak that preceded the Great Depression and the dot-com bubble, and it's dwarfing the peak that preceded the Great Recession. What we're looking at is the third most overvalued stock market. His cycle model here is a little bit more sophisticated than mine. And instead of having like phase 1, 2, 3, 4, it has stealth phase, mania phase, blow off phase, and then we've got this bear trap here, first sell-off, media attention, enthusiasm, we're seeing lots of enthusiasm, greed, delusion. What was the tweet from Kevin McCarthy? I mean, House Majority Leader. His tweet is like all caps and all exclamation marks. The economy is booming. Everything's great and always will be. I mean, that's reaching delusion territory here. New paradigm. We're gonna have peace and prosperity forever. It's totally a whole new turnover, whole new policies. NAFTA is all gonna be different. And then things start to teeter and go down, and our first reaction to the market is it's all going to be denial. Maybe we'll have, this is kind of like this. Maybe we'll have a little spike. They talk about like an upside down W or head and shoulders, and then the fear creeps in, and then we all capitulate and we all start short selling and foreclosing. And then we get back into Zoloff territory, and then somewhere around here we return to our mean, our trend line. So that's his cycle. On the left is the S&P index. So look at that. Look at that right there. And then this and this. That puts us somewhere around here on his cycle. I don't know. I mean, these words kind of, to me, sound like they're describing where we are in terms of market sentiment. But in terms of hard data, I mean, that looks pretty congruent with being here. Huh? Not my chart. This is price to EBITDA ratio. This one just broke right through the high set by the dot-com bubble. We could also, so there's the dot-com bubble. We just busted right through that ceiling. We could talk about the Federal Reserve balance sheet, the 12-month return versus total Fed purchase, 12-month change. The velocity of money is calculated and tracked by the Federal Reserve Board, Bureau of Economic Analysis, and others, Treasury yields, ratio of Treasury yields to S&P yield, et cetera, et cetera, et cetera. Point here is that things are overvalued right now, way overvalued, and that usually, historically, spells trouble. Okay, so that was B. So our first one, our first indicator was volatility. Second indicator was valuation. So volatility seems to point to recession. Valuations, according to charts, maybe suggest recession. Our third indicator is confidence. Here's the U.S. household net worth share of personal disposable income, and going back to the 70s. When this goes up, consumers are confident. Our net worth is really high as compared to our disposable income, and so we feel good. We feel like we're rich. Everything's inflated, but this tends to occur just prior to recession. See, I mean, it's easy for me to stand here and put lines on a white background and be like, oh, look, we're headed to recession. And then, we type this text in here and point to these peaks and valleys. But what does it really mean? I mean, the line comes from hard data. That's a real ratio of net worth and disposable income. But these sentiments, I'm rich, I'm poor, I'm rich, I'm poor, I'm rich. Those sentiments are more difficult to track. I mean, there's ways of trying to quantify them and stuff. But in terms of our hard data, we're up here. I mean, that's dot-com boom. This is right before the Great Recession. 70 is way down there. I mean, we're almost at 680% household net worth share of disposable income. Flick through Twitter for yourself. Flick through your Facebook feed. See how great people are feeling. I mean, maybe that's where we are. Maybe this goes down again. We'll see. We're moving on to labor. This is, I think, 4 out of 5 of the indicators. Make America Great. Unemployment is at a historic low, and it's true. Look how high it was in 2008. I mean, that's our recession. It's flipped, right? That's the recession. That's employment. Everyone's unemployed, and we've been in recovery since then. It's really, really, really low. It's scary low. So this metric, this NAIRU, it's supposed to be similar, maybe more sophisticated than Milton Friedman's natural rate of unemployment. This is the non-accelerating inflation rate of unemployment. So if unemployment goes below that line, then inflation rises, at least according to the theory advanced by Franco Modigliani. If anyone here is Italian, I apologize for butchering. I assume it's Italian, Modigliani, and Lucas Papademos. So we've actually spent just about a year below that line, below the Fed's NAIRU estimate. Okay, unemployment's low. It's a good thing, but it's weird because when it gets low, when it gets below the line, then we get recession. So it feels good. I hate to be the bearer of bad news and doom and gloom, but it goes in cycles. It's a fact. Okay, here's another one related to unemployment. Okay, so we've got the house price index compared to unemployment. So house prices go up when unemployment goes down. They crisscross, and that makes sense, right? People are employed that buy houses, and then economics, prices go up. So we're here. I mean, how much farther can this go? The thing about unemployment is it can only go down. So unemployment can only go down so far. There's a floor. I mean, everyone who wants to be employed is employed. Then now unemployment's not going down anymore. So there's a limit to how high the house price index can go, because this has a floor. What's going to happen here? What's going to happen at the bottom, wherever that bottom is? Well, it's going to bounce. When it bounces, people get unemployed, then housing prices sink. So, I mean, we put the dot up there at the top and the dot here at the bottom. We put a dot here, but we don't know where that is. But it's going to be here or here or here or here, and this is already pretty much as low as it can go. It's lower than the Fed inflation adjusted blah blah blah. So where are we going from here? I mean, it's like, you want to know how far off it is. It's close. We have an inflating balloon and we have a needle that's going toward it. And we don't know how far that distance is now, but sooner or later the balloon and the needle are going to meet. All right, so that's employment. Next category of indicators, Fed policy. So this is a table showing the dates at which the Fed hiked interest rates. So the first column is when they started hiking interest rates, and then the second column is the last hike in that hiking phase. And then here's the result. We've got recession, 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 soft landing, recession, 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 soft landing, recession, soft landing. So we got, 10 out of 13 Fed hikes land us in recession. So check this out. Out of 13, we got 10 landing in recession. This happens when they switch from an easing or a dovish policy to a tightening or a hawkish policy. The entire makeup of the board turned over when Powell took over from Yellen, and they all started hiking in December of 2015. They hiked 6 more times, 2 of those in 2018, and they haven't stopped yet. And at their August meeting, they said, labor's strong, And Powell suggested another hike when they meet in September. Here's another chart. You get the idea. Okay. So how stable are the economic conditions? Not very stable. Is a recession inevitable? Yes. How much longer do we have? Probably not long, relatively speaking. Anyway, thanks for having me. I really appreciate it and enjoyed it.
Thank you.